I wanted to share with you a strategy that I have seen work for quite a few of my borrowers that they didn't think about. And I had one in particular today that was really great for saving them a ton of money at cash to close and also their monthly payment. This strategy may not necessarily work in particular for everyone, but it's a great thing to think about because many people believe that mortgage insurance especially is extremely expensive, where it actually may be the opposite. So I wanted to share a couple of slides with you and tell you where I am coming from. And so this strategy, like I said, is for 20% versus 10% down. And again, this is a specific scenario for someone I am working with right now, but it can work for many people, and that's why I wanted to share it. So, particular for my real estate agents, I get the question quite a bit about, so why are we only putting 10% down versus 20% down? And I'm always going to tell them that it is a strategy. I don't always have buyers who only have 10% down in assets. They truly are looking to save where they can and take advantage of the market because purchasing real estate obviously is an investment, especially in our market today where we do expect to see appreciation to continue. And there is that option on a conventional loan to remove that mortgage insurance sooner rather than later. But also we do anticipate rates to come down, and we're looking at loans in more of a short-term time frame right now because the option to refinance is something that is very viable in our market today. So when I talk to the real estate agents, I let them know that it is truly a strategy in most cases, and that they should not use just down payment to determine which offer they take in a multiple offer situation. So the couple of options, like I said, that I'm going to go through are that 20% down. Here I'm going to use a $320,000 purchase price. 20% down gives us a loan amount of $256. Interest rate I have at 7. We're not going to talk about interest rate today. That's just where we're at in the market. Term is for 30 years, and the monthly payment I have is $2265.50. That's a bit higher than what these terms above say, and I'll explain why in just a couple of minutes. And then cash to close would be $70,366.64. I'm always giving my buyers all-inclusive estimated fees, including lender fees, title fees, prepaid taxes and interest and insurance, so that they have a better idea of what they're truly looking at for costs. And then if we look at that 10% down option, same purchase price, our loan amount is higher at $288. We're going to use the same interest rate for now, and term of 30 years, same. Our payment is $2158.80 per month, and that doesn't seem to make sense for now with the higher loan amount at $288,000, and I'll explain that. And then we see that the cash to close is obviously going to be less since they are putting half as much down. And in this situation, they're actually saving over $18,000. For this particular buyer, that is great because she is on a fixed income, drawing from her retirement. And so any funds that we can keep in cash for her is going to be just helpful for her as she's on a fixed income. Otherwise, these funds would be coming out of her retirement account. And that's where we want to make sure that we're not making our buyer's house poor. As far as the payment breakdown goes, if we're looking at the 20% option, we're at a principal and interest of $1,703.17. Property taxes and insurance I have estimated on this property at $168.33. Those are all obviously going to vary per property. Mortgage insurance, because there's 20% down, is 0. And again, this buyer can afford in cash to put 20% down, but it's not likely going to be the smartest option for her. Her total payment is $1,871.50, and I know that I had said $2265 previously, but I'll show you why. This is her total housing payment. And then she also has a car payment of $394 per month. That means her total obligations per month are $2265.50, and that's where I came up with that monthly payment. If we look at the 10% down option where we're already saving $18,000 in cash, we are looking at a principal interest higher, of course, than that 20% down at $19,1607. Property taxes and homeowners insurance are the same. We add that mortgage insurance in, and in her case, she has a decent credit score, and so her monthly mortgage insurance is very cheap at $74.40 per month. That means her total housing payment is $2158.80. And her car payment is zero because we are paying that off as part of her loan. So she is losing that car payment, and she is getting $18,000 back at closing. So she has a total monthly obligation of $2158.80. And that in addition to that $18,000 cash she's saving, she's also saving $106.70 per month. So all around, for someone who's on fixed income, drawing money from a retirement account, this is going to save her per month. She doesn't have to worry about that monthly car payment. And in her situation, she's aging and may not keep that car for very much longer. It'll be her last one. This will also be her last home. And so these are permanent payments that really help her because they are fixed for the duration. I just wanted to take one quick look also at that mortgage insurance because again, I know that it holds people up. And so I wanted to compare the two options more in dollars for you. So if we look at private mortgage insurance on a conventional loan, that is mortgage insurance that is always removable. Typically, it is removable if you request it, if you have 20% equity in your house at the time that you request it, and you've made 24 months or more in monthly payments towards your mortgage. And in this case, her monthly mortgage insurance is $74.40 per month. If she were to stay in this loan and not refinance out of it, which is also an option, and that can be removal of mortgage insurance as well, sooner than that 24 months if we refinance earlier than that, and that is something in this current market we would be looking at. If she were to stay in the current mortgage for 24 months and get that 20% equity, after 24 months she would have spent $1785.60 in mortgage insurance. Whereas if she would have put 20% down in order to avoid that monthly mortgage insurance, she would have had to put an additional $32,000 worth of retirement savings into the transaction versus that $1785.60. So there are lots of things that you can do with that extra $30,000, right? For her, it's making sure that she has that stability in her income for retirement and not having to be house poor. I hope this is helpful for you in finding a strategy other than just a straight vanilla 20% down conventional loan. And if you'd like to talk about a specific situation, I would love to help. Thank you so much for taking the time to listen, and I will talk to you later. Have a great day.